So we jump into the content. Anytime you start seeing moves like that, a lot of five wave moves, okay, in that direction of varying degrees. And you start seeing a lot of kind of these choppy moves, ABCs to the downside. Okay, doesn't matter where you are in the wave count. Okay, it doesn't know if you know the specifics of Elliott. Let me break him off to the side a little bit. ABC. Doesn't matter if you know all the specifics and intricacies of Elliott, but if you can kind of just identify 5 wave moves to the top side, and you can see 3 wave moves to the downside, you know, each one is not going to be drawn perfect, you know, picture perfect. Okay, you've got to kind of look. Market's going to try to disguise its patterns the best it can. And I think this rally in the S&P following that E-wave low is just that. It's a funky move. It's 1, it's 2, it's 3, and there's a little bar 4 there, up and 5. And each one of the smaller waves is a 3-wave move. And that would signify that it's a motive, but there's 2 kinds of motives. There's an impulse, which looks like this, which is no overlap between 4 and 2. And each of your trend waves is a 5-wave move. Okay? That's what you call a motive impulsive wave. And I'm going to just take about 4 to 5 minutes here and just go over some concepts. Last week we covered corrections. This week I want to cover trend waves. So the real trend waves, all right, are called motive. There's 2 kinds of motive waves. There's an impulse, like this. Actually, let me just do that. Impulse, like that. And what you'll notice, again, is each of your trend waves, 1, 3, and 5, break down into 5 clean, smaller waves. So if you're looking at this black, or actually this brown wave 5 move here, you know, you can see that on like a 30, 60, 90-minute chart. But then if you want to look inside of each of the smaller waves, you go down to a smaller time frame, a 15-minute chart or 30 or whatever, and you look for 5 smaller waves. That's an impulse. The other kind of move that you have, other kind of motive wave, is called a diagonal. And it's going to be shaped like this. Let me just draw it out here. Diagonal, there we go. Increase. All right, so let me just stretch him out a little bit. All right, so in a diagonal, you're going to notice some key differences, and that's what this S&P is. All right, so we'll do diagonal. The difference here is instead of each of your trend waves being a 5-wave move, you're going to see that each of them is a 3-wave move, ABC. Degree increase. Hold on, let me just get these on the same degree. So I'm looking at sub-minuet, degree, and I'll explain what I'm doing here. Sub-minuet, there we go. Ooh, that's not good. A little bug there. Okay. So each of your trend waves, 1, 3, and 5, are 3-wave moves. So this one, we want ABC up, down in 2, ABC up in 3, down in 4. And you'll notice that the wave 4 moves into the territory of wave 2. That's not the case over here on the impulse, but the diagonal, it does. So let me just do this. Preferences, show lines. Right. Oh, no. Preferences, show lines. Preferences, show lines. So those are the 2 different kinds of trending waves, which that the real name for it is a motive wave. And that's the name of the software we're using, MotiveWave. So if you look back here at the S&P, the move off the lows has been it's very difficult to count it as 5-wave moves inside of your trend waves. This is very hard to count as a 5. Wave 3 is also very hard to count as a 5. And then if you get into smaller time frames, wave 5 is also hard to count as a 5. So it takes on the shape of a diagonal. So that's absolutely fine. Now, diagonals can only happen in waves 1 and 5, not 3. Okay? So diagonals can only happen in 1 and 5, not 3. Basically what happens is a diagonal is a move that's having trouble getting started, or it's a move that's just getting underway. All right, and if a first wave is just coming off the lows after a long triangle consolidation like we talked about in the S&P, that makes perfect sense. So it's just it's just going to kind of get into play. Coming out of a triangle consolidation, the market isn't going to perfectly draw out. A lot of times it's not going to perfectly draw out an impulse and just say, hey guys, look, nice clean 5-wave move up by me. I'm going up. Now the market's going to try to hide itself from you a little bit, and that's where I think a diagonal comes into play. Okay, so that's a diagonal. Now, an impulse, the difference there is an impulse can happen in any trend wave, which means 1, 3, 5, but must happen in the third wave. All right, so what that's saying is you can't have a diagonal in a middle trend wave. So you can have a diagonal in 1, you can have it in 5, but you can't have it in 3. 3 is your big breakout trend wave. All right, that's when stop losses go off above the high in 1. That's when breakout traders get involved, momentum guys, kind of latecomers up here just before the wave 4 sets in. So diagonals, which are these kind of sideways consolidation, moves, are either having trouble getting started in 1, or the move is very tired and extended up in 5, and it's set to reverse. But in third waves, in the middle, you're always going to have these nice big breakout waves. And those of you who are newer to Elliott and have a hard time counting Elliott Wave, one of the most important things you can do is make sure in your third waves, you can count a motive impulsive wave. So that brings us back to the S&P. We look to have had a motive diagonal up in 1, and we've just done a beautiful ABC down in 2, right? And, this is something that I put up with customers. This is something I put on Twitter all over. I put a couple charts up, had some fun with this one yesterday. And where is it? Yep. So, the market looked pretty heavy yesterday. And, this is the same chart we were just looking at in the S&P. Here's your diagonal up. A 3-wave move down. And if you guys were trading the markets yesterday, stocks were kind of getting crushed. And it was a little scary. So I put this chart together, this cute little kid. This is a methodology gut check. Because when you're in the middle of this move, it feels like, oh my God, short the market, short the market, short the market. Because spoos were just making lows and lows and lows. It just felt like it was falling apart. But this is a time where you really got to step back and say, all right, set the emotions aside. Trade what you see, not what you think. And what I saw was a diagonal 5-wave move up followed by an ABC move down into fib support. All right, so what I want to do is spend a little time just showing how we calculated this fib support, because what happened was we bounced. Okay, we didn't fully break out to new highs yet, but we came right down to the upper level here, 2019, and we rallied up to 2043. So, that's a 24 S&P point rally. Anybody who's intraday trading 24 points in the S&P at $50 a point, you can pay some bills on that. So, yeah, Perry, you're muted. If you want to talk, get it on your mic and I'll let you in here, no problem. But yeah, everyone's muted who has a microphone. But if anyone wants to talk or ask a question, let me know and I'll unmute you, no problem. So that's the market right there. I think the S&P has reached support, and this 2019 to 2010 was a methodology gut check. And what I meant by that is trust your method. Trade what you see, not what you think. Set the emotions aside. And if you did that. Okay, we are net long stocks with clients. Yesterday was not a fun day. We were down in the portfolio yesterday, but we did hold this 2 fib level support. Okay, and the fact that it's green means it's ideal. Okay, green is your ideal fib levels. So the first thing that we did, and let me just kind of start over from scratch, and I'll show you how we did this. Let's get rid of that one. Let's get rid of this one. And let's get rid of this one. Okay, so here's how you do it. After an initial 5-wave move up, which can be either an impulse or a diagonal, you're looking for a 3-wave correction. We did corrections last week, and I apologize that the archive was not done properly. Basically, I'm an idiot, and I was recording the wrong screen. I have 6 of them. Actually, I have 9 of them on my desk, but 6 on this computer, and I was recording the wrong screen. So I had a lot of people ask from the archive. I guess you guys really liked that video last week, so I appreciate it, and I apologize, but I can easily do it again. I was going to do it back-to-back. I wanted to do trend waves this week, but I'll do it again in the future, and thanks for all the nice feedback. I guess you guys really liked that one. So after every 5-wave move, you're going to look for a 3-wave retracement. So that's what we got. Move up, ABC. The first thing you want to do to figure out where support would be in anticipation of your next trend wave, which, guys, type in, get ready, I'm going to ask you an important question. After a 3-wave move in wave 2, we're expecting a 3rd wave. What kind of motive wave should we be expecting once this wave 2 completes? Type it in the chat window if you don't mind. Okay, so the way we're going to, while you guys are answering that question, the way we're going to be doing this is you want to look for your first fib retracement. Great job, guys. Impulse. Well done. Yep, great job. There's 2 kinds of motive waves, an impulse and a diagonal. Can happen in any trend, 1, 3, and 5, but must happen in the 3rd. Only happens in waves 1 and 5, not 3. Well done. Okay, so the first thing you want to do is you want to do a Fibonacci retracement of your wave 1 compared to wave 2. Ratio analysis 2v1. So again, MotiveWave has it plugged in. Just right-click on any of the degrees you want. All right, I want to study this black circle 1. So you can click anywhere on this dotted line. You can even go down here. Ratio analysis, the 2nd wave versus the 1st wave. And with this version, we have them color-coded. Blue means that's the outer, I guess not outer, but that's the earliest support level you'd expect to come in. So blue is the earliest. Green is the ideal. And orange is the latest that you'd expect the move to test. So we went through 38%, down into 50, and almost gave the 618 a test. So that's a pretty good test of support. So what you want to do to keep things clean is just right-click on the ratio and just remove any ratio that didn't come into play. I'm going to leave the 618 and 786 up just in case things get hairy today. But that's the first thing you want to do. Now, also with fib price, we are option traders. And a great part of Elliott and fib is we can also figure out not where a move will start and stop, but when a move will start and stop. And for option traders, that's really, really valuable. So the next thing you want to do is click on the wave you want to study. And again, I can click anywhere. As long as I'm studying this black 1 and 2, I can click down here and go time analysis. Same thing, 2v1. What we're doing here is rather than measuring total price travel in wave 1 and taking 61% of it, we're measuring total time traveled. All right. You guys thought we'd be just trading, trying to make money. We're traveling time here. So we're going to study time traveled in wave 1 compared to projected time traveled in wave 2. You'll notice the 38% almost grabbed the A wave low, which, oh, interesting. I bet you it grabbed the price as well. So you just kind of extend a line, 38% price retracement right there, 38% time retracement was right there. We just missed it. It's right there. So you just go over from price, up from time. That would have been the ideal. We just missed the low there. Moved up in B and then down in C. Also, you'll notice that we tested the 618 time retracement right there. And the 618 price retracement was right there. So this is when price and time collide. Just missed it. It would have been at 2017 at 10 a.m. The low was 2019 at 10:24 a.m. So we missed by 2 points in 24 minutes. So not bad. Okay, this, you can't make this stuff up. And again, I'm not making this up. This is just classic Elliott fib price and time. I mean, these are the tools that are available to you guys with a little bit of education and the right software. So we moved up, and now we got to be thinking we're inside of a wave 3. Now, if that's the case, actually, you know what, before I want to do, let me step back. I want to do one more study here. We just did the analysis on Black Circle 1 and 2. Now, let's kind of refine it and go inside of this ABC. A lot of times at an ABC correction, the distance traveled in A will be equal to the distance traveled in C. So basically, if you guys ever heard of a two-step correction or a zigzag or an AB equals CD or just a three-wave correction, there's a bunch of names for it. So all you do is you just click on the degree you want to study, right-click ratio analysis, and I want to know C versus A. So wave C, ongoing C versus A. We did not hold the 100%. Okay, I was looking for the 100% to hold, but actually I wasn't. Because why? The higher degree fib retracement was at the earliest level of 38%. So he said, all right, you know, maybe the 38% would hold because that's the point at which C wave is equal to the distance traveled in A. All we're saying there is from 2064 down to 2041, so 23 points or so. Another 23 point sell-off would put us right there. But because we're only at the shallow 38%, we would ideally get down to the 618, which is more typical in a wave 2. That brought in the 1.618 relationship. So 24 points times 1.618 gave us the low at 2019. And you'll notice that is right on top of the 618 price retracement. So what we had here was 61% retracement of this move in price, 61% retracement of this move in time, and a 1.618 relationship of A versus C. So that, again, you know, that's just, you know, this is what gets me out of bed in the morning. I love just being able to uncover patterns and rhythms and lows in the markets that unless you're using these tools, you wouldn't see. You know, emotion was very high yesterday, just kind of watching everyone freak out. Microsoft was down 10% yesterday, and oh my God, everyone was all freaked out yesterday. And what did? We just went right down into ideal technical price, time, and support, and bounced. So from here, this is the next step on our MotiveWave discussion here, trend wave discussion here today. If this is the case, and let's just take a look at the futures here. Futures are up 5.75 handles in the SPOOs, up 42 in the NASCrack, and the small dudes are up 3 points. So we have a little bit of strength here heading into the Fed. If this pattern starts to materialize and we are in fact out of this nasty consolidation, how far can this third wave go? All right. Now, here is how you trade with the motto of my company, which is plan your trade, trade your plan. Big, bold letters up there. You want to lay out some targets for this ongoing third wave. All right. You want to see how far this move can go. And remember, it's going to be a motive and it's going to be an impulse if it's right, because an impulse can only happen in the third wave. Can't be a diagonal. So that means waves 2 and 4 should be removed from each other, and we should get nice 5-wave subdivisions in each of your trend waves. So the way you lay this out is typically your third wave is your longest wave. This is the breakout wave. People were very bearish yesterday. Microsoft was down 10% on the report that they expect very weak 2015 growth, and biggest stock in the Nasdaq was getting crushed. So very bearish market, and if those people who are short start to cover, this is when you start to get a third wave begin to generate. Then you start getting breakouts above 2064, and then you said, everything's good, and people are going to take whatever they want from the Fed statement today and say, this is going to be a good, this is good for the economy. Central bank supportive, they're continuing to be dovish and push higher. That's how a technical third wave pattern unfolds. Now, this is the point where the biggest buying occurs. So it's usually longer than both waves 1 and wave 5 in the future. Wave 3 is usually the longest wave. So the way you can come up with a minimum projection is take distance traveled in 1 and just simply project it higher in ongoing potential wave 3. So you just go ratio analysis 3v1. And you're looking for the 100% relationship. This is the distance, 2097, that was traveled in wave 1. So if this is the case, we should get up to 2097. If, at a minimum, if we are on the right track, ideally, because this is color-coded in blue. Remember, blue means the earliest target. Green is your ideal target up at 2147. So that means this is how I lay out my plan. I generally put the third wave right in the middle. This is kind of a minor level, 1272. I generally put the third wave right there. Okay. Then what I do, and this is how you lay out your trade plan. I know wave 3 needs to be 5 waves just like this. So then what I do is I right-click, decompose as an impulse. And MotiveWave has a problem here. It kind of drops some. It's trying to auto-count down here, which if I just left it here, does that look right? A little short 1, little short 2, up in 3, and then a massive 5. No, that's probably not right. It's probably not right. So what you want to do is just lay out your future points based on an ideal Elliott Wave pattern. Okay, just if you picked up a textbook and if it showed you an impulse pattern, it's going to look like this. It's going to look like that. Just a nice little 5-wave move. Wave 3 is the longest. Wave 4 is kind of short and choppy. A little wave 5. It's going to look like that. So using the starting and stopping point that we've produced based on our fib projections, lay out an ideal fib point. Lay out an ideal impulse wave. I'd say that looks pretty ideal. It doesn't look good if you do this. Look how short that 1 and 2 is compared to 3, 4, and 5. So what I'm doing here is I'm trying to show you guys a little bit more advanced technique, which is those of you who are doing Elliott and using MotiveWave to start labeling waves with the proper degree. I would say that's a pretty good model for where the market should go. So that means that this is not blue 1. That's probably part, the first and second wave of blue 1. Remember I said impulse, which are wave 3s, break down into 5 smaller waves. So this red 1 right here, is equivalent to the blue 1 in the real market. So that means we have green 1, 2, 3, 4, and 5 to go. And we should do the same thing. Green 1, 2, 3, 4, 5. So using our plan, we know that, all right, that's probably 1 and 2, a little 3, a little 4, up in 5. Then we pull back in 2. What does that tell you? That tells you that traditional, highly visible technical resistance, everyone sees 2064. Anybody who's ever read a technical analysis book will be like, oh yeah, there's resistance up here at 2064. But guys, highly visible technical level support and resistance, I feel, is the most subjective, ambiguous way to look at the markets. How do you know if that's going to hold or fail? People say Elliott Wave is ambiguous. I say trendline analysis and support and resistance is the most ambiguous style of technical analysis out there. How do you know if that's supposed to hold or break? It's resistance. I mean, the textbook says it should break. How do you know? I think there's a 50-50 chance that that holds or breaks. And there's a 10% chance of that for you airplane aficionados. Using Elliott, I would say there's more than a 50% chance that this resistance holds because we have a completed 5-wave move. We're anticipating a 5-wave move up into wave 1, then a sell-off, right? So the game plan for us today is to look at 1, 2, and for a little rally up in 3, 4, 5. And if you look at this, I'm looking at my time scale, that takes me out, and there's one little issue. I'm going to try to work with, try to maybe get Tony to work on this. The S&P, if you look at my scale down here, the S&P should stop here. And then as we go out, it should go into tomorrow's session, right? So we're looking at, I'm just estimating from here, that's going to be, let me see, 1, 2, 3, 4, 5, 6, about 8 hours up into this level. So that's about a session and a half. Okay, so the S&P, that's about a day and a half in the stock market. So that takes us out into the middle of next week. Or sorry, middle of to the end of this week. Okay, so the outlook for the market is just for a 5-wave move up into resistance. That should carry us through today into tomorrow and possibly into Friday, into the end of this week. So that's the outlook. Is it going to happen that way? I don't know. Do I think I have an edge over the market? Yeah, and I do. But the most important thing, guys, is it's better to have a plan. It's better to have a plan and trade it, okay, and have faulty analysis, okay, than to do no analysis and have no plan. If you have a plan, then we can go and approach today's market with an idea of how we're going to handle moves and what we're going to do. So if you have the plan, then you're ahead of the market, and the likelihood of a emotional, costly move is significantly reduced. You come into a trading day, sometimes your plan's right, sometimes it's wrong. Most important thing is to not react and be like, oh my God, I'm wrong, and just try to revenge trade back to the market, because that's when you blow up your account. Okay, so always have a plan. That's why I love Elliott. That's why I love Fib. That's why I love using MotiveWave software, because it helps me lay out the plan. And you know how it goes, guys, with a speech or anything you do in life. If you're prepared and you've put in the work, you can walk into that event, that speech, that presentation, whatever it may be, prepared and confident that I know what's going to happen. If it doesn't happen exactly as planned, that's okay. I have a contingency plan, which is your alternate wave count, which is something we'll leave for another time. So, it's much better to have a faulty plan but be prepared than to have no plan and not prepared. All right? Because when your faulty plan doesn't work, you say, okay, I was wrong that day. No need to swing back the market and try to get back. All right? So that is the S&P, and that is a quick discussion about trend waves, impulse, diagonals, and how it pertains to the S&P. And I know I have that recorded. And yeah, Don, great question. That becomes the alternate count. And as I just said, maybe you missed that, or maybe I missed your question. That becomes the alternate count. And MotiveWave has a wonderful feature in there where you can track different wave counts. And I always have 2 wave counts, right? And if it's wrong, then I'm going to quickly move over to the alternate count and trade any pending setups that are on the alternate count. So you always have 2. The S&P is a big old mess right now, so it's not a great example to go in because I'm actually bullish on both counts, which I don't love. Either way, I have this as a triangle here with a wave 2 support, which kind of makes me nervous. But believe it or not, both of my wave counts are bullish. So, no problem, Don. But yeah, primary and alternate counts, I'll definitely save that for another session. So that's the S&P. Let's see if there's markets you guys want me to take a look at. Let me know. Gold's another one that we've been tracking. We were long gold, exited, and we're looking to reload on the gold market. I know there's a lot of stuff in here. And I always joke, I was the kid who drew all over his notebook in school. So now I get to draw all over charts. So gold's trading well. I think gold is one of the better trading markets in here right now. It's technically trading well. It's reacting to 2 things. One, the realization that central banks are continuing to be easy or dovish, as we discussed, and easy central banks means more cheap money sloshing around the system, which should bid up the price of gold. And people don't know this, but gold not only trades up in an inflationary environment, but it also trades up in deflationary environments. So, there's D words been tossed around a lot in Europe. And I think part of the reason you're seeing gold bid is that. And number 3 is it's a volatility hedge. All right, so let me see if I can do this. I'm going to really confuse this chart. If you just overlay the VIX on top of it, you will see, and what I did is I'm going right-click, add study, instrument overlay, and then VIX. You're going to see that there's a pretty decent correlation with the VIX and gold. So as soon as that pops in, basically when volatility moves up, so does gold. See, VIX moves up, pulls back in wave 2 for gold, VIX pulls back. VIX goes up, and what was interesting, gold kept going, but volatility was actually giving you the heads up that you need to be out. And we were long gold. We were long on this wave 3 breakout. We exited into 1,300. Part of the reason was the fib resistance up here in wave 3, but another reason was the volatility coming off. So what I like here is both bottomed at the same time. And if volatility wants to continue to move higher, then I like gold to the top side. And I know there's a lot of stuff here. Let me just hide that degree. Let me get rid of, remove, real simple. I'm thinking wave 4 is over and we're going to move higher in wave 5. Again, today's discussion is about motive waves, impulses, and wave 3. Let me get the VIX out of the way. Wave 3 was a impulse. We have 5 waves. I'm counting that as 1, 2, 3, 4, 5. And then people say, well, so that my friends, colleagues and guys in the business say, well, Todd, what about all this stuff that you ignored in the middle? How do you ignore that? Well, you don't ignore it. Remember, as I said, a third wave needs to have 5 smaller waves. There are your 5 waves. Same thing. A third wave needs to have 5 smaller waves. So let me just go down to a smaller degree. There you go. So that black 3 makes up 5 waves. So you do 1, 2, 3, 4, 5. So you're not ignoring it. All I'm doing is just trying to keep the chart simple. So I'm just hiding different degrees so the chart doesn't look like my high school notebook. So we go 3, 4, same situation. If this is in fact wave 5, and I'm just kind of laying out wave 5 based on a textbook Elliott impulse wave, it should end in this direction. It should probably take this slope. Maybe that's a little steep. Just looking for a nice 3, 4, 5. Okay, you should go up into some fib resistance. So then you just do the same thing. All right, let me just pull all this stuff over that we used to call the top in gold and just get that all over in one area. So that's just a wall of fib resistance there, which is why gold held. And you want to just lay out the likely path for the gold market. And it's actually looking pretty similar to the S&P, which is wild. Okay, so if we do that, we do 1, we do 2, a nice 3, pull back in 4, up in 5. So we have a gold plan. And I tell you what, this count requires, let me go from a 3 hour to a 1 hour. This count requires wave 1 to hold support. The minute wave 2 goes below, watch what MotiveWave does. Uh-oh, you got a problem. Wave 2 terminates beyond the origin, and then if you get too far, it gives you the red signal. So again, guys, this is trading with a plan. Based on Elliott, we should not move below 1272. Trading 1286. Am I guaranteed to be right in this analysis? Absolutely not. Okay, I think I have a small edge over the market in terms of predicting where we're going. But then what compounds that and it gives you the ability to make money over time is the fact that we're going to risk 1286 to 1272, $14 to make what? Remember, how do we project how far wave 3 goes? Distance traveled in 1 is your minimum. Right click, ratio analysis 3v1. 100% is right there. 1309. So we have 1286, 1309, 1425 to make 25. And then if we're right in the trade, we should get up to 1325. Okay, so 1286, that's 15, so $40. So if we're right in the trade, we should get up to 25, make 45. If we're wrong in the trade, we're going to risk 14. So if you have a small edge over the market, You then can risk X to try to make 2X. That's how you make money trading. We have a plan. It might be right. It might not be right, but that's trading. Okay. So guys, I'll leave it there. Head of the market. And I saw that nobody left. So, questions were tight, but it seems like you guys were enjoying it. So if you have anything you want me to cover here real quick, let me know. If not, we'll leave it there. Oi. Sorry, was that a lot? Also, I'm on CNBC here today, so I got to get my stuff in for CNBC. I will be back ahead of the Fed at 2 o'clock to our research customers. And what else? Storm of the century, Snowmageddon, what a bust. I hope everyone in Boston's okay, in Connecticut, but what a bust. I was looking forward to a lot of snow. I did the video for clients yesterday, and let me see here. I think it was in this one. I was really looking forward to wrapping my kids up in the the kids in a Christmas Story. I couldn't wait to throw the twins out there in a couple feet of snow and show them what real snow is. Good morning, but no good. So anyways, hope you guys are all okay, doing well. Good luck on the Fed. Hope that helped today. And yeah, Gary, I'll take a look. Guys, we'll just do a little bit of analysis here real quick, and then I'm going to sign off. Yeah, Gary, longer term SPX. Let me go to the members area. Let me see what I have here. Major. Oops, got to update that one. Yes, I do. Okay, 3, 4. Yeah, this is the one we're working. Okay, so let me go out to a monthly. All right. So this is, oh yeah, that's the analysis I just did. I'm going to delete this. You guys, well, we have this recording, so I'm going to delete the stuff that I just did. Diagonals out. Okay, perfect. Stability less than 1 month. Okay, so this is the analysis I'm looking at on the longer term. So the 2000 NASDAQ high was wave 3. We did A, we did B, we did C down into the 666 low in the S&P. And then here's what I'm tracking. I'm still bullish the market. And I think we've just done on the monthly 1-2, small degree 1-2, and we're working towards the end of blue wave 3. So this rally was a third of a third, up in 3. Sell off in 4, that would be somewhat equal in price and time to wave 2. Probably be longer in time than wave 2, but similar in price. Rally up in wave 3 towards around 2,800, and this is into the next 2 years. Long period of consolidation as we digest this move that we've had. After that period of consolidation is over, then we eventually move up. And then, unfortunately, I hate to do this, but I'm looking at a wave 5 of a 5 pattern. S&P up to around 3,100 to 3,800, and that's like 2020, so 5 to 7 years out. I am not bearish the market. I am, in fact, bullish the market. The extent to which I'm bearish is pending blue wave 3 completion. We should have a blue wave 4, which would be equal to this decline, which I think that was 1375 to 1085. So, not 280 S&P points. So that was about a, 10%, whatever that is. 130 is, yeah, no, that's actually more. So that's like a 15% retracement there. So we should have something similar to that in terms of blue 4. But long term, I do see the market moving higher. I'm not bearish this market. Okay. Hope that helps, guys. Good luck trading today. And I'll talk to you guys next week. All right. Have a good one.